Bring that ass back like a boom, 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 boom.
Hey everyone, this is Supernova. We are with Boom Traders Weekly Overview, October 23rd, week number 42 of 2022. Happy Sunday, and let's review. Now, this is the session overview. We have our models, we have the market price action, internals, notes, sentiment, seasonality, and summary at the end. So, let's get it going with the models. The overall market model, we moved it to buy caution just because we did have a follow-through day. Yes, Friday was a follow-through day number 6 in this bear market, and we are getting very close to the average number of follow-through days in a bear market, which stems from around 9 of them. So 9 to 10 is around the average number of follow-through days that do fail in a bear market before we actually have a bottom. So we're getting there. Now, I warned you some caution. That's why we have our overall market model with buy caution. There is some things that you have to understand about the Friday rallies, and when we're looking at the charts, we'll show you exactly what I mean by that. So for now, just take it as the overall market model has moved to buy caution. The breakout model is also on caution, so it's advisable to try and trade some stocks that are breaking out, just because we never know whether we are hitting the bottom or no. But as I said, this is yet another follow-through day, and if we stay true to Investors Business Daily IBD canceling model and Mr. Zonio investing advices on a follow-through day, we ought to try some trades. As far as long, mid, and short-term models, the long-term, of course, clearly on negative. The mid-term still on negative. And as I said here in the parentheses, we've put like think months for the long-term, think weeks for the mid-term, and think days for the short-term. And the short-term, we put it on a positive with Friday's rally. Now, let's take it to the market price action. Take a look at some charts of the indices, and now I'll show you exactly what I mean by you have to exercise some caution. So, as you know, this is my overall market view in Thinkorswim. Now, let's just switch it to SPX and SPY, whatever. S&P 500. So I want to show you a couple of things. Now, the first thing that you've noticed already and you are familiar with from my videos, I do have a bunch of chart bubbles right here that indicate different things. Now, the first thing that I need to show you right here is the net highs, net lows for the S&P 500 since on Friday. We are still on minus 507. So that means that the net lows were more than the net highs by a total of 507. Although we had this huge rally, although it was on huge volume, as you can see right here, this volume was far exceeding the 20-day moving average. I would warn you some caution not to jump too aggressively on buying new stocks just because of this. This is basically telling you that there's something innately wrong with this jump. And if you're familiar with options and options delta and gamma, this was actually the result of quite a substantial, around 20%, I think, of all the puts in the market expired on Friday. So they had to be closed or they expired worthless. And whenever we have such huge positions of puts that are expiring, is when the market is making such substantial gains. Now, that doesn't mean that there are no more new puts being opened. I'm just saying be careful, because this might be a little bit of a treacherous situation where on a Monday, the market makers and big players will start buying puts again, which will again move the market slower. So be a little bit cautious when you're doing your buying. Apart from that, yes, the market did held. There were some highs that were made from those 3 bars right here. We barely held them. Could move downwards. This is the 10-day moving average, the white line. So you can say it held. But in reality, I don't think that anything has really fundamentally shifted in the market. Yes, we have this follow-through day. As I said, it was the result of large put option positions expiring or being closed. But overall, with this minus 507 for net highs, net new lows, you can judge by yourself. Nothing really has changed that much. So be cautious right here. We have the 50-day coming in at 387 and another very important level at 390. Tomorrow I'll update you with more levels depending on overnight futures that are starting Sunday night. So I'll update you in chat with more levels. But for now, if we are to break above and go forward, of course, there's an obvious high right here around 380 that we have to capture. And then we have a huge candle right here, so it's a little bit of a fast zone up until 390. So 390 is the very important zone that we're looking for if we are to rally, of course. Now let's look at NASDAQ. And NASDAQ pretty much did the exact same thing. I mean, there's not much difference. These large put option positions, they do actually create a ripple effect throughout the market. So it's no surprise that NASDAQ held. Again, the 10-day moving average right here if you want to see. There is this oscillator. I'm sometimes using stochastic momentum index. You can see clearly there was a divergence between the lows. Right here, you can see we're making a lower low where price is making a lower low, where the stochastics is not really making new lows. The lowest was right here. And if we're talking about levels, 291, which interestingly coincides with the 50-day moving average as well, but we also have to take out these highs around 282. One thing I forgot to mention right here, if you look at the S&P 500, 360 is the level that we need to hold. Otherwise, I think we're going to be undercutting the lows. IWM, pretty much the same thing. Strong rally. However, there's a difference right here. This island reversal candle was not touched, so it still stays as resistance. Right, this level stays as resistance. We weren't able to get into the body of the island reversal, and it also coincides with another three bar island reversal right here. What I mean by island reversal is we have a gap prior to the formation and we have a gap after the formation, and you can see those 3 bars are somehow lonely hanging in the air. Same thing right here for this candle. So it doesn't look that good in my opinion. And also, if you notice right here on the NASDAQ QQQ, net highs, net lows minus 388. So really, this you have to see there's like a huge divergence between what's happening in the market, the index, what the index showing, and what the stocks are showing. So with that many net new highs and net lows, you can definitely sense that something's wrong in the market. Now, if we have to talk about oscillators, market oscillators, you can see what we have right here. NASDAQ is still below the S&P 500, which is generally a bearish signal. NASDAQ being the white line, SPX being the purple line. As far as my oscillators that are based on advanced decline issues and spike breadth thrust, you can see the McClellan oscillator as well. They are ranging in the midsection right here, so nothing too extreme. Market is basically in a middle position. Now, we're done with the market price action. Let's take a look at the internals. And to do that, we have to go to my flexible grid. And there are a couple of things that I want to show you. First thing is the put call ratio. You see it's dropping a little bit, right? You can see it's dropping a little bit, which is showing that we might have hit like an intermittent bottom with the levels right here around 105, but it's still not. It's just in no man's land. So to put it, it's just in no man's land, the put call ratio. You want to see it above 110 for extreme capitulation, and this just shows there is some bullishness starting to appear, but extreme bullishness goes below 0.75, and we are nowhere near that. So market is really not convinced in that. As far as new highs, new lows, I showed you before. You can see what's going on. This is a comparison between NASDAQ and S&P 500. Again, see NASDAQ is the white line, S&P 500 is the purple line. We are definitely not going above the zero, although we had this huge rally. Now, this is the volume, the up-down volume. You can see it was elevated on the upside for all four major indices. You have here the New York Stock Exchange, NASDAQ, Root, which is IWM, and Dow Jones. So the up-down volume was definitely elevated. For Friday. VIX didn't drop as much. You can see right here, VIX didn't drop as much as the S&P 500 basically got up, and this is the advanced decline. You can see the number of advancing against declining issues. This has nothing to do with the 52 highs and lows. So there are two completely different internals showing right here. One is showing the number of issues that are actually making gains compared to the issues that are making losses, posting losses. And the other one is, which is right here, is showing you the stocks that are making 52-week highs against the stocks that are making 52-week lows. So the stocks were advancing, yep, but they were not making new highs or new lows. So they weren't really strong in their advances, so to speak. And last but not least, here is the S&P 500 stocks above their 50-day moving average. We definitely moved to 0.28, but we're still looking for something like 0.5. So 50% of the stocks in the S&P 500 being above their 50-day moving average, and only 22% of the stocks in the S&P 500 are above their 20-day moving average. So indeed, as I said a couple of times already, indeed we did have a follow-through day, but there's still a lot of things that are raising red flags. So just be careful when you're making your positions. Control the size and control the risk. Now let's go to my notes. I have only a couple of things right here, and I just want to pretty much basically repeat what I just said in the other sections of the video. So we did have a follow-through day. That's an important notice, but again, that's number 6. Average number of failed follow-through days in bear markets 9, 10. So we do still have some time to go. The market rally was largely due to a put expiration on Friday. It was OPEX, third week of the month. We had a huge put positions expiration. They were closed, and last but not least, nothing really fundamentally has changed. Yep, there were some talks from members of the Fed. They might be able to achieve their goals with lesser hikes in terms of percentages, and the market was trying to hold on into this because the market is deeply oversold, and any good news right now is like a very rare ray of sunshine coming through. But also there were also comments that that the price that the markets and people are going to pay if the Fed is not achieving their goals, and they're trying to lose up a little bit on their policy, will be much higher than the price that the markets will pay if the Fed continue with their strict hawkish policy. So it's it's a game. It's up and down. But at the end of the day, really, these are the three things that you have to understand. We did have a follow-through day. It was largely due on this put expirations on Friday, and nothing majorly has changed for the market. So don't get really excited and trying to buy everything that breaks out. As far as sentiment is concerned, this is the American Association of Individual Investors. It goes 1 week back. So the week ending on the 19th of October, you can see the bullish against the bearish sentiment. Bearish is predominant, definitely. Now, probably next week when we report on this, it will be higher just because of the Friday rally, and it will be shown in the next report. But you can see nothing really has moved in terms of sentiment here for the past month or so. The CNN fear and greed actually moved to neutral, which is interesting. And you will also see when we talk about our seasonality that these last week of October and starting into November, usually the market rallies. So in terms of seasonality, you have another basically layer telling you that the market is actually positioned to rally. And you can see 1 year ago with the same week we were at greed at 60, so the market was probably rallying. I haven't actually looked at the chart. But right now we are in fear. The previous close we are in neutral on 45. Previous close was 40, and 1 week ago we were at 21, extreme fear. So you can see there's like quite a jump in 1 week from extreme fear to neutral. As far as Bitcoin, it hasn't really moved at all, which in a way is good, in a way is bad. But in such a bad market situation, especially when we're talking about inflation and macroeconomically situation with war between Russia and Ukraine and the European Union involvement into it, I think that actually crypto is behaving pretty well, being very stable, hanging around this 19.5, 20,000 for Bitcoin and 1.3 for Ethereum. I think it's maybe you call me crypto bull or whatever, but I actually think that the crypto has found its bottom, and it's been stable no matter what, whether it's good news or bad news. Right now there's lack of money going into the crypto markets, and this is not going to change for quite some time. But also remember that there are quite a lot of people holding crypto as long-term investment. So I think that at some point, and maybe we've hit that point, market volatility will subside, and we're just going to be looking for a very prolonged flatline, so to speak. Now let's get into the seasonality. And you know our cycle work for NASDAQ. It's Ned Davis research right here. Just at the end of October, beginning of November. This is actually showing it a little bit earlier, but with all the macro things that are going on, this might move a little bit to the end of the year. Right around here, we are supposed to be getting, a push forward for NASDAQ, and especially for Dow Jones, where the second presidential year is, the worst. For stocks, right around here at the end of the year 22-23, we're expecting a push and going strong into next year. So this is what we have for seasonality. It coincides with what is happening right now in the market. But again, please be respectful of the fact that this rally on Friday is nothing more than just 1 day, and it was due, as I said many times already. It was due because of large put option expiration. Now, as far as summary goes, the models, buy caution, so you can try some setups. Some are appearing, especially with Friday's run. The market is stalling right now, meaning that we are not making either new highs, we're not making new lows, we're just staying pretty much flat and bouncing in and out of range. The put volume is lowering, so is volatility. VIX dropped, but not so much. And of course, recession and Fed hikes are still a thing, so don't disregard this. In general, if you want, if you want me to sum it up with a few sentences, I'll just say: be extremely careful, be extremely fast in your trading. Day trading right now works better, and be extremely controlling of your risk. So don't let losers run. Sometimes when you're in a bull market, you'll say, it will stop at the 20-day moving average. I can buy more. Just don't do this right here. If your stop is hit, get out. I would generally say if your stop is hit, is get out, but this is extremely treacherous conditions right now, and your stops might be the difference between boom and bust. So I hope this was beneficial. If you want more, as I said, we have levels, we have alerts. You can join our Discord, or of course you can watch those videos every weekend. We are right here with you, helping you in your trade. So please leave a like, comment, subscribe to our channel, and I'll see you here next week. Till then, safe trading and stay patient.